What's going on, everybody? It's Jared Fausnaught. I'm here with Conor Reilly. Welcome to Minicast number 6 for Washington Capital Partners. This has been a really cool series that we've been doing and trying to bring everybody some value. Today, we're going to be hitting on a really cool topic, cash versus leverage, the age-old question. So getting into it today, we'll jump right in. We've seen the market doing some really weird kind of things that we haven't seen in the past. You know, basic economics have been at play, and we're going to talk about it today. So diving right in, Connor, what have you seen in the market? Let's start high level, and then we'll get into the weeds. What are you seeing out there?
Absolutely. So the traditional things that you would normally be seeing is that people are paying asking price and getting leverage for that, whether that's if they're an investor, getting leverage from a bank or a hard money lender like ourselves, or what's happening now is that people are willing to overpay on properties because of the limited supply. And in order to make transactions go faster and win the bid, people are paying all cash. So today, probably really focusing on, like you said, cash versus leverage, but what goes into those things? Why are people using cash? How is it impacting the market from what we're seeing versus what we could see in the future?
Yeah, people need to understand what's going on in order to be able to make informed decisions about their real estate portfolios. Deciding, like, if you were a flipper before, is it now the right time to be building a rental portfolio? Like, it's always a trade-off. The market has cycles, right? And these cycles happen over decades, and repeat themselves. And you have to know where you are in the cycle. And is it the right time to be doing, flipping or rentals? I think we'll come to that conclusion as part of the conversation. But yeah, we've seen massive increases in home prices. I believe the stat was for January was the first time, at least in the DC metro area, that average home prices didn't actually decline. And normally they decline by 4 to 6%. This year they actually increased by 8 to 10%. So, I mean, really just kind of stunning information that's very telling on what's happening right now. And it's becoming, so
Difficult.
in a lot of ways. Yeah, it's becoming difficult to get the properties, and it's also becoming difficult from an affordability standpoint.
Yeah, that's one of the biggest things. And we talk to a lot of people in the off-market space, and one thing that is really reoccurring is that a lot of people who are selling these off-market properties, who they would normally be working with real estate investors, who are biggest thing for them is the purchase price, because you make your profit when you purchase, but they have these agents coming to them with very, very wealthy or well-off clients who are willing to pay all cash and over asking just to secure the deal. And it's to the point where some of these people are even like, I don't even recommend buying at that, but they're still willing to do so. But the reason they're doing that is because there's two trains of thought there. A lot of people did very well in the stock market 2019 and 2020. They want to take their proceeds and put it into a more secure security. So people are moving their funds. And two is because what they're doing, if they have the cash, is they're taking it, buying it quickly, and then they're actually taking advantage of the low rates. After closing, they do a cash out refinance and they replenish their deal. So what they could potentially do is, very easy numbers is they purchase a $300K property that might have been listed for $250, right? They're going to pay $300 for it. They'll cash out refi, and maybe they're getting $260 back, right? Now they just paid $40K for that property. what's going to happen down the line once foreclosures actually do get to proceed and evictions and everything like that, the rental market is going to boom. We're seeing new builds for rentals occurring. So people are preparing for that rental market to get larger and larger. So they're going to they're going to hold these properties as rental properties. And as you mentioned earlier, like, is that the plan of attack for people? For those that are wealthy and have the funds, that's kind of what we're seeing right now, because you're not seeing the all cash transactions for large development plays or complete guts, right? It's things that can be done 50, 60 grand, maybe over a 2-3 month period, and then get it rented.
So are you, what would you say percentage wise, like just for, as a point of reference, to do a little name dropping, we do have an off market channel for properties called greatdcdeals.com. Everybody should definitely go check that out. And so we have a lot of data on off market transactions that we help and sell in one form or another. What would you say as a percentage, just talking very, very high level, is our cash transactions? Like if we had 100 transactions in a month, how many would you say?
It's probably, it's right now over the past, let's call it 4 months, probably 60 to 70% are all cash.
Yeah. Yeah. And that's, I mean, that's so valuable. A lot of people, are tossing so many offers in on different properties, and really their wheels are spinning. So
yeah, we get, I receive all the offers all the time and get a chance to review them. I haven't seen a property go under asking in the past 9 months. I think I've maybe seen one or two, and that was just because the construction budget was just incorrect. But everything that we've seen, even off market, is going over asking. A big part of the cash versus leverage thing is if you do have extra cash, you can also utilize leverage as well on the purchase. I have a client who listed a property at 925, and they listed it on Monday. By Saturday, they had 26 offers on the home, and someone was willing to pay 1.45 for the property because likely they just had seen so many properties and they lost so many. So she was willing to throw more money into that 925, utilize the same leverage just to secure a property. So that's another way that cash is coming into play.
interesting. So are you seeing people refinancing out with traditional financing?
Yeah, people are taking, if they're buying all cash, especially for an investment property, within 30 days, they're cash out refinancing, they're replenishing their funds, and maybe they're just doing it again because I think, what are we at? 2.8, maybe 3 for the rate. I don't recall right now where it's at.
We're 3 now. It jumped up. It did have a jump up, but it was under 3 for a while there.
But they're taking advantage of those rates, which I suggest people do, especially for the rental for rental properties. One thing to think about, however, is moving forward, starting, I think it's April 1st, Fannie Mae is limiting their number of purchases from lenders in terms of secondary homes or investment properties. So investment secondary homes can only make up, I believe the number is going to be 7% of their entire portfolio. How is that going to impact the cash purchase to refinance transactions that are occurring? Do those people need to go elsewhere? Are they going to just keep all the cash in the deal? That remains to be seen, and probably won't really know until about 6 months.
Yeah, that's a great point, and kind of dovetails into what I was going to mention, which is, it's great. Rates are really low. Traditional financing is awesome. Those rates are more so relevant to like traditional mortgages, but obviously rental products and stuff are not all that much higher. But yeah, the challenge with it is it's just not as scalable, as our world of financing, which, I'll just plug us right now. But yeah, it's great, right? Like you can buy cash, you can refinance out with crazy low rates, but you can't rinse and repeat, all that many times because they're looking at your balance sheet. They're balance sheet lenders, and they want to understand the personal debt to income ratio of the individual borrowers, right? Whereas we've got some very interesting products. We haven't touched on it too much. I'll just do a little hint for a future mini cast here, but with our 30-year products, it's all solely focused on the debt to income ratio of the property, so you can scale way better.
Yep.
Cool. So I mean, why? What are some other reasons, just in general, why lending? Why leverage over cash?
So you were talking about the scalability.
Yeah.
That's one of the major reasons there. Let's go back to the 300K property, for example. Instead of putting all 300 grand into that property, you could utilize leverage, whether it's with a hard money lender or a bank, just leverage in general. And maybe you're asking for 50% of the purchase price. Now you're only putting 150 down. You can go find another 300K house and have your 150 for that. You can buy 2 houses in the same day as opposed to only being able to buy one. For the clients that we work with that are doing a ton of deals, we recommend that all the time. We're not here to, let's not over leverage you or whatever it is, but let's keep the dry powder in your pocket so you can go after more deals. That is the biggest thing in the cash versus leverage conversation is, how are you actually utilizing your cash to make sure that you can get into the most properties, and understanding what your business model is. If you want to do 1 to 2 deals a year, okay, right? Doing the cash only transaction, that makes sense. However, if you're looking to scale, as you mentioned, 5, 6, 10 deals a year, you need to leverage, but you need to leverage correctly.
Yeah, absolutely. And I don't think we're definitely not trying to say here, like, don't use your cash.
Oh,
It's always going to be a combination of the two. So,
mm-hmm.
You need to get your cash working. If you have it sitting in a bank account, you're getting crushed right now by inflation. And I mean, this is another conversation rabbit hole that we really could spend a whole mini cast on. But, I don't think people really, thought through the leverage, the amount of inflation that will be coming along with the trillions of dollars that is being pumped into the system.
Mm-hmm.
And it's going to be a challenge for the Fed to try to control this. And it's going to be hard for them to raise rates too high because it could collapse everything and, fall into a deflationary cycle. So it's this really tough balancing line that they're trying to walk. And, that's going to mean your cash that's just sitting there is losing value. So get it working.
I was reading somewhere, I don't remember if it was for the year or for the month, but equity increased by about 20 grand per property across the US. Is that sustainable? I don't have an answer to that. However, if you're buying all cash, you already have the equity into it. If you're leveraging and using cash, your 150 you put in is now 130 when you refinance.
Yeah, absolutely. I mean, it is definitely, although you keep hearing buzzwords of it's a bubble, it's a real estate bubble, everything's getting blown up, and I think I don't think the two are, mutually exclusive. I think you can have a bubble and still have correct fundamentals, real estate fundamentals. So supply and demand is working as it should right now. We've talked about this in another mini cast, but this isn't like fraudulent banking practices that are leading to a bubble or something like that. That people get loans that shouldn't have multiple loans. This is just a supply demand thing. And so, I think that's actually a sign of a healthy market. So, Yeah, but yeah, now should be the time to buy. I mean, you sent me a graph the other day, mortgage rates, all time mortgage rates, and
Yeah.
it's shocking to see, in like the 70s, it was literally double.
14, yeah, 14% or something of that nature.
I think it topped out at 18%.
Mm-hmm.
So it's really shocking because if you're at 3%, you know, and inflation is growing at 2 to 3% thereabout, I mean, literally, it's free money.
Yep.
You're putting your money into your house is protecting it. So
I think this goes into a whole other conversation, but are people buying based on rates or based on value? And whether that's for an investor or for a homeowner, that's a decision for them. I'm in the camp of always buying for value versus rate, because let's look at the individuals that had 5% interest rates. Well, look what happened. We got to this point and they were able to refinance at 2.5%, but their value was higher because they bought a property at a um, lower basis point. Did they buy it all cash? Maybe their equity increased. I was reading somewhere, I believe 20% of all transactions in the US is actually considered a cash transaction. I would assume that number is only going to continue to go up for maybe another year or two until everyone's dry powder kind of runs dry. But we are seeing a huge influx of what's considered foreign money, of investors from overseas coming in and just buying up properties. I think we're seeing down in Miami that these foreign investors aren't even actually living in there, but this is where they're parking their money, right? Because now the equity of that property is just increasing, and instead of keeping it in the stock market, they're going to actually make more on that property when they do eventually sell.
yeah, absolutely. I mean, I probably don't want to go into it too much, but yeah, the foreign investment in the U.S. real estate is only going to continue to grow. It's always been, pretty popular store of value for, you always hear more media attention around certain countries like Chinese investors, but it's a whole host of different countries that are chasing good returns, and I think we'll only continue to see that as like economies have come back after COVID, things are starting to improve. You're going to see, I think, more money chasing the real estate market here, which could only make it harder to find properties. Another thing we didn't think of, but talk about, and I'll let you jump in here in a second, is the institutional investors. Like, we've got all these institutional investors that are gobbling up single family, properties and adding them to their portfolios. That is also adding to the competition.
Yep. So we were talking earlier before. There's currently 2.7 million people in forbearance. How many of those are going to be able to catch up on their payments, and how many of those are going to become renters, just as kind of what happened after 2008, where people just decided to rent and let the house go? That's why these institutional investors are buying up the rental properties, assuming that this rental market is only going to increase. I think that's a big play, and I do think that that's going to be the largest segment moving forward, because what we're finding is that there's this gap of affordability. We kept talking about that. Millennials are making up the largest home buying group, but they're not buying starter homes. The well-off millennials who have been renting for years, and people have been saying, why aren't they buying homes? Why aren't they buying homes? Have been saving money, and now they're buying $1 million home as their first property. But there's that gap before that are going to have to continue to rent until they can afford that $1 million home.
Yeah, definitely the culture of renting versus ownership, I think, is changing. I think very, very long term, we will see, a society that's moving much more in the direction of being a renting society than an ownership society. If you look at just culture in general and in where we're moving, the subscription based economy is in full force, and I think it will only increase. The Netflix.
You and I love the subscription based things.
Oh my gosh. I mean, not, um, not having to own it, but still being able to use it, and creating the cash flows from the subscription for the businesses that are in that space. I mean, it's amazing for them because they get recurring revenue. But I do think that's where we're headed. And as part of that, like, it's a communal way of thinking. People don't own stuff. Everybody shares things. I just think that that's a direction that we're seeing culturally, as being acceptable in the country, and it'll only increase. Like the more that, the more that kind of the next wave, the third wave of the, web 3.0 with all the cryptos and stuff, allow for more diversification, and allow for more liquidity in real estate.
Yeah.
Like,
so I have a question for you to kind of get back to the cash as a topic thing. Do you think cash is more valuable now, or when the foreclosures do begin to open up and those can begin forward, is cash going to be more valuable now or when the foreclosures begin to occur?
Yeah, I mean, this gets at the idea of liquidity, right? So there's cash, and as part of that same coin is liquidity, the liquidity conversation. So whatever you're doing, whatever vehicles you have, you always want to be liquid. If you've got money in the market, unless you have a trading account that allows you to borrow against that and pull out debt, which is something that I've personally been looking at, but it's not something that everybody has access to. You don't have liquidity if you don't have cash. So I think that the value of the dollar is greater, in times where there's better buying opportunities. You're able to secure a better basis. So yeah, I think right now, to your point, stay a little bit more leveraged. Maybe people are buying with more cash now, but be ready to pull that cash out, with leverage when you're ready, when things start to turn. So
yeah, because I agree with you there, and as I mentioned earlier, I'm in the camp of buying on value. With more foreclosures comes more supply, less demand. The prices are going to drop. The same house that you would pay today for, let's use 300 again, maybe 250 come 2022. And you immediately built in 50K on your purchase.
Yeah, absolutely. That equity can be really huge. Especially for people that are just getting into it. We talk to so many just new people into the real estate investing space. They're just trying to get their first rental or just get their first flip. So, that kind of equity being built in for somebody that's just starting out, that's maybe trying to leave their 9 to 5 or whatever. I mean, that's so huge. So
even starting with Burr on that, save cash right now, do a house hack right there. If you're able to pay more down when the foreclosures happen, you're likely to win that property. House hack it and refinance it. You've built your equity in, and now you are beginning your real estate kingdom.
Yeah. So big takeaways. It seems like, from what we're both seeing in the market, there is a overall industry from real estate investor mentality towards rentals. We're seeing it, again, we're going to talk about our 30-year stuff in another minicast, but we are seeing a shift to rentals at a much higher percentage. I think that there's still a lot of demand left to go on that side. And I think some of it's just education. People don't know that kind of product exists. They're used to kind of traditional long-term debt from a bank, which again is not scalable. I think it's only going to grow from here. What other kind of takeaways?
Really not using all of your cash for one deal.
Yep.
Preparing for the future. We're already in March. This time next year, we should be anticipating that foreclosure should be able to open up. Be prepared for a buying period when it is a buyer's market. Don't don't look at deals and say, I need this one right now and put everything into it. If you are, get yourself leverage after you purchase it, get yourself liquid again. Staying liquid over the next probably year and a half is going to be very, very key, because there's going to be some great buying opportunities in the near future.
Yeah, absolutely. I mean, like, to summarize, everybody just be flexible with it, have options to be able to pull your cash out if you are going to be all in with cash on a deal, and walk that fine balance between not getting destroyed with inflation and making sure capital is out there working for you, your dollars are making dollars, and then also not missing opportunities that could be coming down the pipe pretty soon. So have your financing options. Definitely talk to any of the folks at Washington Capital Partners, Connor, myself, and the rest of the team. Happy to help anybody that's looking at getting and acquiring more rentals. But overall, excited to see what the future brings. And in terms of making money, some of the biggest gains have been in downtimes. So no matter what happens, people make money in the good times and people make money in the bad times. You just have to be prepared.
Yep, exactly. Strategize for that. Other takeaways: properties are not going under asking anymore. So be prepared to pay a little bit over. Build that into your pro forma. If it's a rental property, how long do you need to keep that property to make up that extra price that you're willing to pay over asking?
Yeah, you have to manage your expectations. If you go in, you're gonna, with the wrong expectations, you're gonna get frustrated. It's gonna be a negative experience. You got to work with an agent who understands what's happening currently in the market. Find yourself a good team to build around yourself. Be ready to sign a lot of offers, to sign a lot of contracts, and just really kind of hunker down and battle it out for some good properties. But overall, they're still out there. We're seeing, tons of off-market volume. So the deals are there. You're just going to there's going to be a little bit more competition.
Yep. There's less properties and more competition at this point.
Awesome. Well, we'll leave it at that. We'll wrap up, but another great conversation with you, Connor. Really enjoyed doing this on a week, and I hope that we brought some good value on the cash versus leverage topic. But we'll be back at it again with Minicast number 7 for the following week, and we'll preview that. Hopefully, we'll get some more folks eyeballs on it. It's been fun.
Absolutely, been enjoying this.
Yeah, cool. All right. Enjoy.
Thank you.
See you, everybody.